participating in our today's 12 GMT webinar because we have a very special guest, Professor Gabriel Talmain from University of Glasgow. The topic of our today's discussion is expansionist monetary policy. Now, central banks all over the world have been implementing quantitative easing in order to try and boost their economies. But which countries have been doing it the right way and which countries have been in the wrong way? Today we have Professor Gabriel Talmain to discuss these questions with us in further detail. But before we start, let me just remind you that we do have the chat section on the left side. So in case of any questions and comments that you might have on the very interesting topic, then feel free to type them in the public chat and we'll try to address them during the webinar. But first and foremost, Professor Gabriel, thank you very much for participating. It is a pleasure to have you in our webinar.
It's a pleasure to be with you.
Thank you very much. I'm just trying to put you on the whiteboard. There we go, perfect. So that everyone can see you. And the first question that I want to address, now, as we just talked about, central banks all over the world have engaged in quantitative easing in hopes that it will give them the necessary boost for the economy. But based on the positive data that we have seen coming out of the US, we saw improvement in the labor market, we saw a rise in retail sales. Do you think, based on these data, it's safe to say that the US has been the most successful country? And if so, what can other countries can learn from its good example and good experience?
Yes, thank you for inviting me to this very interesting talk. Yes, the US seems that it is coming out of this period of which necessitated quantitative easing. It appears that the policy had some success, and the success would be mostly directed towards helping the banking sector. That is what quantitative easing is trying to do, helping the banking sector. Now that the banking sector seems to have been cleared a little bit in the US, the need for this quantitative easing is no longer there and it is being withdrawn.
And the Fed, it actually has also linked quantitative easing to the labor market, stating that it will continue quantitative easing until the unemployment rate drops to 6.5%. Believe that the unemployment rate is the most accurate indicator to evaluate economic health, or should quantitative easing be linked to other economic indicators to ensure that the economy is in fact truly recovering from the crisis?
The unemployment rate is certainly a very important indicator. The link between quantitative easing and the unemployment rate is a bit unfortunate, in the sense that monetary policy can help the financial sector. Its reach on the real economy is a little bit is not that tenuous. So. But however, what was holding back the US since the crisis of 2008 was a credit market that was not working properly. So in the sense that the quantitative easing has helped the financial sector get over the hump of this crisis, then indirectly it's helping the labor market as well. Of course, having a low rate of unemployment is something that is desirable as long as it does not bring inflationary pressure on the economy. And in the present circumstances, that does not seem to be a problem. However, traditionally, it has been so that monetary policy should look at the financial sector, and attempting to use monetary policy to do the bidding basically of fiscal policy may not be such a good idea. So yeah, go ahead. Sorry.
I just saw a question that I think we could address. One of our guests would like to know, now, Professor, in your opinion, when will the Fed end its quantitative easing program, considering that there's a lot of speculation with regards to this particular topic right now?
Well, the sentiment that is in the air that the quantitative easing will start to be withdrawn gradually, starting at the next meeting of the Open Market Committee, and then be withdrawn until the withdrawn to be done by the end of next year. So one has to remember that for the United States, the quantitative easing was a fairly big program with $85 billion injected every month. So taking that amount of liquidity out of continuous resupplying the liquidity with that amount certainly was making life much easier for the banks and indirectly for the borrowers. Once this starts to be withdrawn, well, we'll see how the credit will be affected. If the credit sizes up as it was on the point of doing during the Lehman crisis, in my opinion, maybe the decision to withdraw it would be reversed. But barring catastrophes, then the program will be withdrawn by the end of next year.
And another question I see from the chat, then after the US, what country to your mind will be the next one to consider tempering its quantitative easing program?
Oh, this is clear. Britain is about to withdraw its quantitative easing program. We just saw announcement that in a report from the discussion of the Monetary Policy Committee in the UK, there was a 6-3 vote to ease up on quantitative easing. So there is no doubt that this is going to be tapered off. Now, quantitative easing was continually injecting liquidity into the financial system. Once it is withdrawn, this liquidity is still around. So at some point, unless at the moment, there is a very large demand for liquidity because the banks are trying to reconstitute the capital, and anything that can help with that, they will take. But once this imperative is taken away, then you'll have this sizable amounts of monetary aggregates that will have to find a way. So the question is, what will happen? Normally, when quantitative easing was introduced, there was talk that there would be a reversal eventually, that the liquidity would be withdrawn. If this were to happen at the moment, I mean, nobody would think that this would be done immediately, but at some point this might have to be considered if this liquidity that is floating around starts to push up the consumer prices. At the moment, what this liquidity did was to firm up the prices of bonds in the first instance, and indirectly the price of other assets. In the US, there is also a program to help with with mortgages, and that has supported a boom in the prices of real estate in the United States. Once this is withdrawn, again there is a question of what will happen to the prices of securities. That's why we saw this recent drop in the stock market prices.
Now, moving a little bit from the US, I also want to discuss Japan and its quantitative easing, considering that this was actually the first country to introduce quantitative easing to combat inflation in the early 2000s. Now, nonetheless, we are now already in 2013, and Japan is adopting more aggressive quantitative easing to attempt to reach 2% inflation target in 2 years. Now, obviously, Japan must be doing something wrong as if it's not able to battle its deflation. How do you evaluate their current quantitative easing policy? Do you think it will actually allow them to finally reach their goal?
The policy of trying to inject even more money in the economy might give a temporary boost to through the asset channel, increasing the value of assets, also keeping keeping banks, for instance, afloat, because the portfolio is getting the value of the portfolio is increasing. And this is due to the fact that when there is quantitative easing, then this has a positive effect on the prices of equities. However, the case of Japan shows exactly what are the limits of this monetary policy. The monetary policy can support prices, can support the prices of assets, can help a little bit with lending and with the credit market. However, what it cannot do is clean up the slate. In Japan, what happened was that banks speculated on a number of assets, including the price of including real estate. And when the real estate bubble burst, many were left basically insolvent. Now, once they are insolvent, either somebody has to take the loss, or the government has to step in and come up with the funds to mop up the bad debt, or what Japan did was to support the banks by providing them with cheap liquidity, and so the banks did not fail. But on the other hand, they could not play the role they are supposed to be playing, which is to provide credit to the rest of the economy. Basically, the financial sector in Japan is considered weak. And furthermore, there is a lot of opacity there. So if you don't know if the bank in front of you may be on the point of going under, would you commit to an interbank loan to this bank whose position is unknown, and you may speculate it's not that good? Well, in order to clear up this uncertainty, what is needed is to do a transparent review of the positions of the various participants, and basically allow the weakest ones to go away. Now, Japan, the various governments in Japan have never been willing to bite the bullet and do that. So they are left with basically a credit sector that is not functioning very well. The same could happen in other places if banks are, continue to be supported. Banks that are not viable on their own continue to be supported. And the only way you can find out, well, let's say, no, it's not the only way, but one way we will find out who can survive and who cannot is when this policy of quantitative easing is withdrawn.
And many critics were concerned that aggressive monetary printing would lead to inflation. However, again, we do have the example of Japan that cannot somehow win deflation, and U.S. lowest inflation is currently and U.S. inflation is currently at the lowest level since Kennedy-era economic boom, since in the 1960s. So why do you think that these concerns were unnecessary?
The concerns were very necessary. One is should always be prepared that if monetary policy is loosened, something will happen to prices. Now, traditionally, the idea was that you change the price of an asset, basically of treasury bonds or bills, treasury bills that are being bought with quantitative easing. And by changing the price of these assets, this trickles down towards the real economy, either through investment or through consumption, or a combination of both. Now, if this was to happen, then quantitative easing, the amount of money injected into the economy, would find its way in the final product, either in terms of consumption or investment, and will show up either through increased production I'm very sorry about that. Can I resume what I was saying? Can I go ahead?
Yes, please. Yes, please continue, of course.
All right. So my point was that traditionally one would have thought that monetary policy, if it was successful, would feed to the real economy by increasing prices and hopefully increasing somewhat production. And if production goes up, then there is the demand for labor increases and unemployment would fall. Now, what we see here is that quantitative easing had a very little impact on inflation. There could be reasons for that in terms of the following. If quantitative easing was giving a push to prices, maybe there were other factors that were pushing prices down, such as increased in productivities or the discoveries of new natural resources. One could argue that perhaps the use of the shale or oil deposits, which are being tapped now by fracking, would be a positive shock on productivity that would tend to decrease prices. But if one is skeptical of that, then the only explanation to the fact that money has been injected in the economy and we do not see price increases is because the money did not go into the real economy. The money stayed inside the financial sector, and it increased prices, but the prices of what? The prices of assets, right? So the assets became more valuable, and basically that is how quantitative easing has made its impact on the economy. Now, if one could argue that this put some doubt on the efficiency of the quantitative easing in terms of helping the real economy. This is why I was pointing out that linking the monetary policy to unemployment is something a bit dangerous to do, because the real economy does not react in a one-to-one fashion to monetary policy. In some circumstances, monetary policy would be very effective. For instance, if the financial sector is very sound and there is low inflation, and the productivity is basically at a good level, and there is not a big slump in the economy. If there is a negative shock on output which causes unemployment to go up, then there is scope for using monetary policy. In the present circumstances, where the financial system stability is in doubt, monetary policy is working in a very different way from usual. Basically, putting more liquidity in the economy is going to be absorbed by the players in the financial system, because they crave the security of having liquidity, and fear the fact that basically there are several types of fear. Some institutions have balance sheets that are not so good. They have loans that may not be performing, and so they would face very dim prospects. Actually, the prospects of having to be winded down, perhaps without support from the central bank, and of course these banks need any type of liquidity they can lay their hands on, just to have a reserve in case there start to be the credit lines start to be withdrawn. And then for participants that have more solid position, there is also fear, but they have systemic fear. What if the system starts to size up, as it threatened to do when there was the Lehman Brothers collapse, or when there are the sovereign debt fears about debt, Greece looking like it's going again to be a problem. There will be a crisis again, and this crisis propagating to other weak players in the Eurozone. So of course everybody is nervous about the soundness of financial system as a whole, and that means that there is what the Keynesians would have called a liquidity trap, but in this instance is not the reason for this trap is not the one that Keynes had in mind, or at least that his followers had in mind. It's basically the fear factor and the reach for solidity.
we have discussed today that UK is most likely to be the second country to exit quantitative easing. However, a recent report by the IMF states that the Bank of England could actually encounter losses totaling at almost 80 billion pounds or 5.5% of GDP when it starts selling government bonds back into the market. So as soon as the Bank of England says it is ready to, let's say, discontinue its quantitative easing, this will lead to a sharp decline in bond prices. Now, do you personally think that the cost could be that drastic, and why?
The gilt market in the UK is not as big as the market for treasuries in the US. So so even a small relatively smallish like the Bank of England could drive prices in that market. However, I don't believe that Bank of England would allow prices to drop so much. What I believe, again, there would be a taper effect. Anyway, the Bank of England, one has to remember that the Bank of England was created by a royal charter to help the treasury to finance, basically to finance, to market its securities. Now, it is true that the status of the Bank of England do not emphasize this point anymore, but it would be difficult to believe that the Bank of England would basically default, not be there when the Treasury need to put a lot of bonds out. So if we look at the Treasury side, the need for financing on this side does not look like it's falling very fast. One could expect that the Bank of England decisions on buying or selling bonds would have something to do with this aspect.
And also another question that we had in the chat with regards to the UK, there are speculations that the Bank of England's new governor, Mark Carney, will announce another injection into the economy. So do you personally expect some changes to the Bank of England's policy under the new leadership, or do you still think that UK is most likely the second country to exit its expansionist monetary policy?
I have not followed the track record of the new governor, so I'm not quite sure what he intends to do. Let's put it that way. I only know about his announcements. His announcement is that he will have a prudent policy and he will look for the needs of the economy and will conduct a policy that would also comply with its target with inflation and so on. I would think that, but the Monetary Policy Committee has to vote on this on the decision to continue with quantitative easing or on tapering off. So he will have, even if he wanted to change course compared to what the direction that we are perceiving now, if he wanted to go back to more quantitative easing, he would have to convince the other members that continuing injection of liquidity in the economy is the right thing to do. Another aspect, another point that is also important for concerning this issue is that the Chancellor has announced plans to try to sell, to return part of RBS to the public. So to sell back the equity that they had to take, basically sell back the bank to the public rather than keeping it on the government's book. Now, if the government can get rid of the banks it had to bail out, then it will also, well, hopefully, with when selling them, selling also the parts of the portfolio that are causing problems, then the need for financing decrease, and that is something that would also remove one of the imperative for quantitative easing.
Now, we have also discussed a number of risks, but considering that the world economy has never experienced money printing at this level all over the world. It's not only just the US, Japan or UK, it's also Australia and the Eurozone. Now, to your mind, the most severe risks that are likely to occur when central banks begin to exit QE?
Basically, why was quantitative easing put in the first place? It was because the financial markets were unbalanced and the stability was questioned. If the financial institutions are become more solid, then the imperative for this quantitative easing would be withdrawn. Now the financial sector in the United States seem to have recovered to a good extent, and if this recovery, now the question is this recovery predicated on the quantitative easing continuing? One would argue that the stability of the financial sector has also a lot to do on the expectations of the players, and so we have to ask: did the players in the financial markets, are the people involved in the financial markets, had they expected quantitative easing to go on forever? The answer is no. There seemed to be a sentiment that everybody knew that quantitative easing would come to an end at some point. So on this account, one would think that the stability of the financial markets should not be put at risk by removing quantitative easing, because the expectations of the players are such that they have already taken this fact into account, and they already have priced the asset with the idea that quantitative easing was to an end. One would suspect that the announcement by Bernanke that quantitative easing is that he intends to bring down quantitative easing, and that what we see from the Monetary Policy Committee from the Bank of England is just a message sent by the central banks to the public, to the banks and other financial institutions, that don't forget that this quantity, that this support that is coming every month is coming to an end, and you have to think what you will do afterwards. So what we saw what happened. There was a drop in the price of equity, but there was not. It was not. It was not a complete rout. So maybe some comfort can be taken from that. That perhaps this is not as bad as one might have feared. In any case, continuing the drop feed through quantitative easing is having its own problems, and in some respects, the continuation of this support policy may entail dangers that are far greater than removing them. And a case in point is Japan, which has relied continuously on this injection of liquidity rather than on cleaning up its putting back in order its house. And so what was that the real economy sputtered and did not grow much. So whatever risk there is in withdrawing quantitative easing, the central banks have also to think about what is the risk of continuing it and getting basically the economy work in a way which requires continuous injections of liquidity. That would be very very damaging. I mean, at some point, if somebody has been sick and has been lying in bed, at some point this person has to get up.
Okay, but I know the next question is very tricky, and there's a lot of debate also going around how to exit then QE to ensure that these risks could be avoided, and we can also in the very fragile economic growth. How can then we help this sick person get better so he doesn't, let's say, fall back into his illness again?
Well, what quantitative easing has done beside injecting liquidity is also allow weak players to continue and freeze the competitive structure of the economy. In hindsight, it might have been better to allow the weakest of the weak players to take the normal route, so that so that the strongest player could take the place, and newcomers with renewed energy would come in. So it's not that once the support from the central bank is withdrawn that nothing will happen. In fact, if nothing happened, if the support from the central bank was taken away, would be a little bit worrying, because you would wonder why are weak banks still able to survive when they have the portfolio is loaded with non-performing loans and other assets which value has dropped tremendously. Really, the next question is, how will the financial market look after quantitative easing has been withdrawn? How will the pack be reshuffled? That is a big question. This being said, if interbank lending were to stop after quantitative easing is withdrawn, then that would be terrible. Then it would be basically force to bring back quantitative easing. But why interbank lending would not work? Well, then the question is why wouldn't it work? I mean, the implication there would be that banks still would not trust each other, which means that they may know something that we don't. That is worrying. Hopefully, this would not be the case. However, there is another issue which is also playing a big role here. It is the sovereign debt in Europe, and that issue. Where is it? That's not really quantitative easing anymore. We're talking about bailing out, and the stability fund that has been put in place. And now these are exactly the kind of reforms that are needed to introduce stability in the eurozone financial markets and get the structure of the market, the organizations of the market, and the regulators of the market to be in line with the development in this market. But that's another question. I think that quantitative easing has done what it has done, has been around for 4 or 5 years, and it would be a dangerous. There is a danger that it will become institutionalized and completely twist the competitive structure of the financial sectors.
Thank you very much, Professor Gabriel Talmain. It was a pleasure to have you, and it was very interesting to listen to your opinion.
Thank you very much for having me on the show. It's always a pleasure to talk to you. All right. Bye.
Thank you very much. Have a nice day. Thank you very much. Now, I hope everyone enjoyed the wonderful webinar with Professor Gabriel Talmain from University of Glasgow on quantitative easing. So I hope you have a wonderful day, have a wonderful weekend. The webinar is being recorded and will be available on YouTube so that you can watch it and send to your friends and discuss quantitative easing further. Thank you very much for tuning in. Goodbye.